Hello, this is Chapter 17, Financial Management from the Food Service Management book, Principles and Practices, 12th edition. This is presented by Courtney Ramsey Coleman for Special Problems in Dietetics under Dr. Esther O'Key. The objectives today will be to discuss the basic financial records for monitoring day-to-day in food service, to explore the different categories of ratio analysis, to discuss the factors that affect menu pricing, to describe different types of budgets used in organizations, to review the budget planning process, to list and explain records used in the food service cost control, to highlight examples of cost accounting records, to examine the profit loss statement, to explore the recipe costing process, to discuss methods to establish sales price, and to review some common food service calculations. The basic financial records are income statement, balance sheet, and ratio analysis. Income statement is a summary of financial information for a defined accounting period. It shows whether the business has made or lost money during the period being reported. Balance sheets provide information about the value of the business and how well its assets have been used to meet their financial goals of the operation. It represents a given point in time, and it lists the assets, liabilities, and capitals of the operation as of a specific date. The ratio analysis is useful in comparing present performance to previous time periods, other companies, and industry averages and budget figures. Here's an example of the income statement. As you can see in the example, you have sales, you have food sales and beverage sales, you have cost of sales, which is food costs and beverage costs, you have the gross profit from the operations, and you have the controllable expenses, which include payroll, employee benefits, direct operating costs, advertising and promotions, and music and entertainment, utilities, and admin costs. Here's an example of a balance sheet. You have on one side the assets and on another side the liabilities and owner's equity. Under the assets, you see that there is cash, food inventory, beverage inventory, buildings, equipment, and accumulated depreciation. Under the liabilities, you see the payroll, accounts payable, notes payable, and under equity, you see the capital. This is used to kind of assess where the business is as far as profit and debt. Here's an example of the ratio analysis. It is useful in comparing present performance against periods of time or other companies or industry averages. In the example, you can see they have 3 different years, and they are comparing them to the industry profile. So you can look at the different categories, and you can see, for instance, they have their gross sales in comparison to industry standards. They have their cash. They have their inventory. You can look at the different categories and explore how they meet up to industry profile. These are the different categories of ratio analysis. You have liquidity, solvency, activity, profitability, and operating. Under liquidity, these are the kind of calculations that are going to tell us whether the organization is able to pay its bills when they're due. The solvency category will have calculations that tell us whether the organization's able to meet its long-term financial obligations. The activity category will have calculations that show us how effectively the organization is using its assets. The profitability category will show us how effective the management is in generating sales, controlling expenses, and providing profit. The operating category will show us how successful the organization is in generating revenue and controlling expenses. Here are some liquidity calculations, and I'm not going to go through these in depth. I'm just showing you the formulas so that you will have them for the future. Under liquidity, you have current ratio and quick ratio. Under solvency, you have solvency ratio and debt to equity ratio. Under activity, you have food inventory turnover and average inventory. Under profitability, you have profit margin, return on equity, return on assets. And under operating, you see we have many different formulas to keep track of our day-to-day goings-on in the business. We have average customer check, seat turnover, labor minutes per meal, meals per full-time equivalent, sales mix, food cost percent, labor cost percent, beverage cost percent, and food cost per patient or per student. What factors affect food cost? We have menu, which means different types of foods are needed. Are they exotic? Are they rare? Are they local or are they common? Purchasing. Our purchasing power and quantities will definitely affect the cost. If you are buying a ton of flour, then you might get it at wholesale price. Also, appropriate specification use. That means, are the ingredients being used in the proper recipes? Are they being used in the proper amounts? Receiving, are we checking the deliveries against the purchase order? Are we getting the specified, are we verifying the specifications? Storage, are the storeroom controls at the proper settings in order to ensure quality? What's our turnover rate? Are we having any theft? Are we having any spoilage? Methods of production used. Is there pre-prep? Is there a lot of cooking involved? Is there a use of leftovers? Is there a lot of food waste? All of these things will individually affect your food cost. Factors that affect menu pricing. We have local competition, levels of service, types of customers, product quality, portion size, ambiance, meal periods, which means dinner versus lunch. You expect a higher price for dinner than you do for lunch. Location, sales mix, which is the frequency of which the menu items are selected by customers. Food and labor costs, which varies from area to area, and desired profit margin. A nonprofit would set its prices at the break-even point. All of these things will affect your different menu prices, whether it's a high-cost menu or a low-cost menu. You can't expect to put a high-cost menu in an area that has low income. You just will not succeed. In order to set your menu price, you first need to know what each recipe costs. So we have a recipe costing process. And you find the cost of your process by multiplying the ingredients as purchased weight by its unit price. And then you add all of the ingredients together and you have your recipe total cost. You need to make sure that your weight and your unit price are in the same units. For instance, if your unit price is in pounds, then your weight needs to be in pounds. If your unit price is in ounces, then your weight should be in ounces. Here's an example of costing an ingredient. So I'm just going to show you how to cost for this first ingredient, which is flour. The process is the same for each ingredient. You just have to go through and price each ingredient, and then in the end add all of the ingredient costs together, and you will have your total cost for the recipe. Our first step is to convert our as purchased weight into the same unit as our unit price. So we see that in our unit price it's in pounds, and our as purchased weight has pounds and ounces. So we want to convert the whole thing into pounds. So we're going to take the 2 ounces and divide them by 16 because there's 16 ounces in a pound, and we're going to get 0.125 pounds. Then when we add that to the 3 pounds that we already had, and we have 3.2 pounds, and that is our as purchased weight. Our as purchased weight will then be multiplied by our unit price, which is 52 cents, and we will get $1.63 as our ingredient cost. So, for the cost of flour for this recipe, it is $1.63. As you can see, we have lots of other ingredients in this recipe, so you will price them all out, add them up, and you will have your total cost for the recipe. Once you have your total recipe cost, you then need to find your portion cost. And as you can see at the top of this recipe card, this recipe has 48 portions. So in order to find your portion cost, you want your total cost divided by the number of portions. So our total cost is $16.79 for this recipe. So we will divide it by the 48 portions that this recipe provides. And then you will have your portion cost of 34 cents. Once you have your portion price, you can then find out your sales price. But in order to find out your sales price, you need to have a pricing factor. The pricing factor is used to multiply the food cost to arrive at the menu price. Pricing factor equals 100 divided by the desired food cost percent. For example, if you wanted your food cost percent to be 40%, then you would take 100, which represents the total sales, divide it by 40, which is your food cost percent, and it would equal 2.5, which would then be your pricing factor. The cost of portion times the pricing factor will equal your sales price. So if the cost of our portion was 34 cents, we will multiply it by 2.5, which is the pricing factor, and that would give us 87 cents as a suggested sales price. There are several different methods to establish selling price. We have demand-oriented pricing, prime cost pricing, and break-even point. Demand-oriented pricing is a method in which the price of the product is changed according to its demand. If there's a higher price when the demand is strong and a lower price when the demand is weak. Prime cost pricing is the total of the direct materials cost, direct labor cost, and direct expenses. Break-even point is a point in time when the forecasted revenue exactly equals the estimated total cost. It's where losses end and profits begin to accumulate. And this is the point at which the business, the project, or the product become financially viable. Budgets. No organization will succeed without a proper budget. A budget is a financial plan that helps to achieve future goals. You can see in this example, this is a yearly budget for a company, and they have a month-to-month budget, and it looks like on month 10 they have really increased their budget. They've almost doubled their budget. It looks like they have increased advertising, public relations, direct mail, so it looks like maybe they're really amping up. It might be for Christmas or Halloween or something that they're really trying to increase their sales and make their business presence known. There's different types of budgets. We have the master budget, operating budget, cash budget, and capital budget. The master budget is a compilation of several small budgets and coordinates every aspect of the operation. The operating budget includes revenues and expenses. It's a forecast of revenues, expense, and profit for a specified period or the fiscal year. It serves as a guide for the day-to-day operations and includes the statistic budget, which is an estimate of the volume of sales in the commercial operations. The cash budget is an illustration of the inflow and the outflow of the cash. It projects the receipt of revenue and the expenditure of funds. It determines if funds will be available when needed in order to meet the financial obligations or demands of the operation. Capital budget is a long-term plan prepared to estimate or predict the cost of the capital outlays or expenditures and their financing. It includes equipment replacement, renovation projects, and facility expansions. Budget planning has 6 different steps. The first step is to collect operating data from records and reports, study the data, and evaluate them against the departmental goals. Analyze and discuss the factors that can affect the future of the operations. Discuss and plan for new goals and activities desired, such as remodeling projects, purchasing of new equipment, or adding a new service. Next, you want to set priorities and make the decisions for the next year and what can be included in the budget. And lastly, you want to write the budget up for a presentation. This is a list of cost control records: purchasing and receiving records, storage and storeroom records, food production, service records, income and expense records, and sales and cash receipts. Purchasing and receiving records include purchase orders, invoices, receiving records, requisitions, and discrepancy reports. Storage and storeroom records include requisition and storeroom issue records, perpetual inventory, and physical inventory. Food production records are menus, standardized recipes, portion control standards, product schedules and leftover reports, and forecast and tallies. Service records are documents used to collect and track actual demand for eating occasions and individual menu items. Income and expense records are a record of daily transactions that are essential for the preparation of financial statements. Sales and cash receipts account for cash received, number of sales, and tax collected. Cost accounting focuses on classifying, recording, and reporting business expenses. Here are some examples of cost accounting records: income statements, profit loss statements, balance sheets, purchasing and receiving records, storage and storeroom records, service records, income and expense records, and sales and cash receipts. A profit loss statement is also called the income statement. It shows whether the business has made or lost money during the period that's being reported. The profit loss statement includes income, cost of food sold, gross profit, labor overhead and operating costs, and net profit or loss. In order to calculate it, you subtract cost of food sold from income, and that gives you your gross profit. Then you subtract labor, overhead, and operating costs from gross profit, and that gives you your net profit or loss. Here are some common food service calculations that you will need to know. Food cost percent equals cost of food sold divided by food sales. Labor cost percent equals cost of labor, which includes salaries, wages, and benefits, divided by total sales. And percent profit, which is net profit divided by sales times 100. In summary, financial success can only be achieved by quality financial management. The financial status of the business can be assessed through the system of records like income statements, balance sheets, and ratio analysis. Ratio analysis are used in comparing present performance to previous time periods, other companies, industry averages, and budget figures. Financial goals and objectives can be achieved through planned budgets. Successful food service operations involve strict budget planning, tight control of inventory, and careful comparisons. Here's a little quiz to test the knowledge that you've learned. Number 1, what are the 3 factors that affect menu pricing? Number 2, what is another name for profit and loss statement? Number 3, what is the break-even point? Number 4, what are the 3 basic reports? And number 5, what is the formula for food cost percent?